Good morning, everybody. Welcome to a webinar on how to sell a business, probably yours if you're attending it. My name is Raynor. I'm one of the small business advisors here with the SBDC. I'm hosted at Coastal Enterprises and eager to dive in and talk to you today. Certainly appreciate you all deciding to attend. I know it's a beautiful day out there, and it's the first time I think we've had 5 consecutive beautiful days in a row, and over a year from my memory. Appreciate you deciding to come inside and stare at a computer screen instead of being outside on such a beautiful day. But should you choose to turn off your video and walk outside and bring your laptop, no judgments on my end. A couple housekeeping things just to go over. This will be recorded, is currently being recorded, and it will be emailed out to you as a participant. So if you have questions on things that we're going over, you'll have the recording of this as well as the slide deck. I'll make sure to get that to you. And we're really here for you, right? So our primary service provision is one-on-one, which is confidential. So if you have questions and you don't have an advisor, please reach out. We're full-time positions. There's about 14 of us throughout the state, each with our own kind of areas of expertise, but we're cross-trained and we collaborate regularly, and we're here for you. So I understand this is somewhat of a sensitive topic. Even attending a webinar like this, if you're a business owner, can be stressful. So if you want to change your name as it's presented on the Zoom, or if you have questions on confidentiality and want to leave and just watch the recording, that's fine. If you want to interrupt and ask questions as we go through, I would invite that as well. I certainly appreciate a good conversation around this topic. But most importantly, whatever you are comfortable with is really our goal. So this is a complex topic with a lot of nuance to it. We'll cover some of the basics, but as you go through the process, if you do want to reach out, have more, in-depth conversation about your business, getting ready to sell or structuring a sale, please reach out. I love digging in and talking about that. So today, here's kind of what we're going to cover, and I'm going to fly through a bunch of information because, like I said, it's a very broad and complicated topic, but we're trying to lay some of the foundation just for your understanding. So talking about setting expectations, talk about what you are actually selling and how it is identified and structured, talk about identifying a buyer, touch a little bit on the valuation process. So that you're aware, I do have a valuation credential with the International Society of Business Appraisers. I've done more than 100 business opinions of value. I've been a broker on both the buyer and seller side, so I do have some experience talking about Main Street sales and structuring a business creatively as well as kind of more, conservatively. So whatever the opportunity is, talking through that is something that I really enjoy doing and finding those solutions. So we'll end with kind of that idea of structuring the deal, what kind of structure to look for, and then of course, preparing to sell and what you can be doing now, what you should be doing, a year out, 6 months out, and closer to that point of transition. So one of the key concepts that we're really going to keep circling back to through this is that a true transaction, a true sale, is an agreement between a buyer and a seller, right? And I like this, this perspective that I included at the bottom here. A buyer is really somebody that you are hiring to replace you. For most small businesses, they are going to be working exactly doing what you do, 40, 50, 60 hours a week. And the labor market is tight in Maine, right? So that idea of I'm going to hire somebody to replace me, and they're going to pay me for that privilege. Coming into the idea of selling your business with that understanding of what does the buyer see, and how am I communicating that value to the buyer and having them meet me where I'm at and meeting them where they are at is a critical part, because no transaction occurs without the buyer and the seller being in agreement. Right. So this topic, while, I've called it selling a business, it's really about understanding what the other table is going to be looking at and putting yourself in the best position to have that communication. So some anecdotal expectations. I still work with some brokers in the state of Maine. This is not like real estate, right? There might be a real estate component, but to truly capture the value of an ongoing business, that goodwill purchase price, only about half of businesses are selling. Again, there's that lack of demand, that lack of buyer in the marketplace. And days on market, the time it takes between a listing and a transaction is between 12 and 18 months. So again, this isn't the housing market where, days on market is less than a week. It is a time-intensive process that requires a significant level of a commitment. And more than half of the deals that I work with, significantly more than half, probably about 75%, if they have a goodwill value, then the seller remains involved. So again, this is not a quick transaction. This isn't a situation where, oh, the coffee machine broke and I just don't have the energy to fix it and I want to sell this week. We can certainly talk about that. That's essentially an asset sale or liquidation. But if you're looking at the true value of your business and capturing that and recouping that, it is an ongoing and somewhat difficult process. So what are you selling? How do we identify what a sale actually is and what you are bringing to market? So when we talk about selling a business, it's really this, right? It's that idea that it's the ability of your assets, the assets that you've created over time, or the assets that you've purchased or made or put into place to create, to reliably create cash flow, right? There's a bunch of different pieces of this that we're going to really dig into, right? So assets, right? First and foremost, what are my assets? How do I identify assets? There are both tangible and intangible assets, right? And a lot of business owners, when they think, well, it's an asset sale, that sounds like a liquidation. That sounds like, throwing it up at auction. Not necessarily. Most businesses that are sold that are, under 5 million in revenue a year in the state of Maine, Main Street businesses, the businesses that I deal with, are asset sales. What an asset sale is essentially a buyer is buying a predetermined list of both tangible and intangible assets with a new company. So it can be done, and most often is done, so that the customer does not understand that there's been a transaction that has taken place. So the buyer says, hey, I want to buy the assets as a new company buying this list of assets. Yeah, it's furniture, fixtures, inventory, equipment, but it's also the business name, the website, social media accounts, historic financial information, right? All of those things are still considered assets that you can sell. And so that group of assets gets transferred to the buyer. This is a key part when we talk about preparing to sell and laying the foundation and building that discussion with the buyer. Transferable assets are sellable assets. You have put an incredible amount of work into developing a customer list, a reputation, right? Goodwill, right? The whole concept of goodwill is the value of the intangible. It is what can be sold. But if you are the only person who knows those things, who can do those things, if you are the business itself, where people come into the business because of you, and you are the reputation of the business, that is not transferable, right? So in order to recoup that value that you've created in yourself, you must stay with the business, right? And so the buyer would need to hire you to benefit from that reputation that you've created. The more that you can do to make those assets turnkey is kind of the term that's thrown out, but transferable, where you say, here are the keys on the day of close, and the buyer can pick up and take off with what you've sold and what you've given them. They don't call you after that, right? And there's a benefit to that. You can move to Florida, you can go somewhere else, you can just retire and enjoy. You can invest your time and energy in another business and launch something else, right? So getting able to have that separation and move beyond while still recouping the value means you have to be able to give them those things. So processes, standard operating procedures, right? This is always the litmus test. When was the last time you took vacation? What happened to the business when you did so? Could you step away for a long weekend? Could you step away for a week, a month, right? the more of these processes that you're able to put in place, these operating procedures, these management checks and balances, the easier it is for you to extract yourself from that business. And more importantly, the easier it is for a buyer to step into that business and add their own strengths. So that is assets and how we view assets, tangible and intangible. Tangible assets, easy to transfer. Yep, I left the car parked in the parking lot. Here are the keys, right? Intangible assets, much more difficult to transfer unless you're building those resources as you go. So let's talk about the second piece of this, right? So when we talk about what are you selling, we've got our assets. These are the assets that we've used, that we've generated, that we've made over the 15, 20, 30 years that we've been in business. And we use these assets to generate cash flow. Right? When I talk about an income statement, the financial statement of a business, that's the story that you're telling with the assets you have, right? So you've got your balance sheet, the assets, which is essentially like saying, hey, I've got a computer and that computer has Microsoft Word on it, but I want to tell a story with that, right? Yeah, I've got these things that I have, but what am I doing with them to create a narrative, create a story? The story that you are creating, the operating performance of your business, is essentially the cash flow. It's the story of how well you're using those things, right? It has to be reliable for the buyer to look at that and understand the value. And so when I say reliable cash flow, I'm essentially meaning three things. I'm saying what is legal and demonstrable, right? So I'm not the IRS. This is a recorded seminar, but we don't take too many questions as we go through it. And there's no judgments from me as far as tax mitigation strategies go. So if you're a cash-based business and some of that cash comes in and goes out, it is what it is. I'm not, not here to judge, like I said, but a buyer's not going to understand that. Buyers might not believe that. And if a buyer believes it, then their accountant probably won't, or their attorney probably won't. And they have that team with them, right? So if you're preparing to sell and you're thinking, hey, I'm 3 years out of my business, start looking at your financials with that in mind. Say, what, if I pay more in taxes over the next 2 to 3 years, yes, I have to pay more in taxes, but it's demonstrable. I can show the value of this business, the amount of excess cash that is being created by my assets, by the story that I'm telling, right? So what story am I preparing to tell the buyer? Tax returns are the most common way that this is shown, right? Because a tax return is usually submitted through an accountant. And so there's that kind of third-party approval of the financials. And then historic consistency is a big part of this. So I say, okay, 3 years is ideal. In the last 3 years, obviously, with COVID and everything that has gone on, has been fairly disruptive to a lot of industries. But typically, if we're planning ahead and looking ahead, if you have 3 years of committed, consistent, legal, reliable tax flows that tell that story of growth, of strength, then there's value to that. It's showing how well you're using your assets. If it's all over the place, or you only have 3 to 6 months of consistent performance, or you've just started that process of showing everything that's coming in and going out of the business, there's more risk to a buyer. It's less reliable. Why not just take that money that they have and put it into the stock market instead, or put it into a retirement account and get back a consistent return, right? So the more consistent you can make it, the more transferable you can make it, the more value there is to that other side of the table. So who's buying that reliable, consistent creation of cash based on the assets, right? That ability of the assets to create cash flow. Who is buying it determines what we're going to look at. Right? And I've kind of thrown this together. I know it's a lot of information. We have someone on our team who's wonderful at presentations, and they hate this slide because they, it's too much information and people are reading this rather than listening to me, right? You'll get the slideshow. We'll go through it. The most common buyer in the state of Maine is either the second column or the third column. The staff or family member, probably the most common that I deal with right now. The second most common is that owner-operator. Both of those, what they are actually buying is a job for themselves. Right? They'll pay for the ability of the assets to create cash flow, but they're buying a job, a chance to plug themselves into the business that you've created and theoretically improve it, right? And in both of those cases, because they are plugging themselves into where you are, the revenue will be more or less consistent with historic performance, which is why they're so concerned about consistency. And the expenses will be more or less the same with some adjustments, right? And so they're really honing in on that bottom line, the net income, the cash flow of the business. And they're saying, okay, is that enough for me? Both of those cases, because it's based on the historic performance, it's fairly easy to transfer so long as that sale price is supported by the cash flow. And the buyer has some wherewithal to buy in. And the disadvantages is that it's really and it's capped by that cash flow, which we'll talk about in a minute. Now, there's also this third column, which we can talk about a little bit, which is a synergistic buyer. Sorry, fourth column, far out to the right side there. A synergistic buyer is really focused on the top line, because when you think about a synergistic buyer, they have their own expenses in their narrative, and they're interested in just the market share. What are your customers? How broad is your marketing strategy and outreach and historic customer list? We have our own accountants, we have our own legal and professional, we have our own location. We just want that book of business, right? That's really most common with like an accounting practice or an attorney, some medical practices where they're saying, we just want your customer list and we're going to bring that in-house. Now, because they're buying that, then the purchase price is a little more flexible because they're looking at what that value will be for them. And the expenses are kind of, that it's a poker game at that point. They have their hand and they know what the cards are, but you don't know what that hand is. Benefit of a staff or family or an owner operator stepping in is what they're buying. You both have the same hand. You both know what game is being played. You both know the cash flow that is available. So like I said, the staff, family, owner operator, they're buying the bottom line of the business, the excess cash after expenses. The synergistic buyer is really focused on the top line, and they're supporting that with a bank note or a loan based on what both businesses together are going to be able to support and generate. And that's the poker game, because you're trying to figure out what the value is to them, and they already know your books, right? Paid for by the cash flow of the business. So what's in a cash flow, right? So a couple terms that are thrown out a lot, right? Net income, EBITDA, and SDE. Net income is probably something that you're all familiar with, especially because here we are, April 18th, and I know the state of Maine, had some extensions for tax filing, but by and large, a lot of people look at their net income around tax season because it's what you pay taxes on, right? Is what is left in the business. So that's the bottom line. So typical income statement, profit and loss statement, three parts to it, right? You have your revenue, sales over the period of time, a year, if you're talking about a tax return. You have expenses broken out into two pieces: direct cost, cost of goods, and then overhead costs, everything else. And that leaves you with your net income, right? Your net income is what you use to support your balance sheet, buy new assets, pay down liabilities, or dream come true, no liabilities, assets are in a good place. You get to keep all that as an equity draw, right? So that's, high level overview of how those financial statements work together. When we're talking about a cash flow, we're really focused on the first financial statement, that income statement, the profit and loss. And we look at the bottom piece, which is that net income. That's the starting point, right? EBITDA takes it one step further. You got your net income, the dark blue piece, and then we add back three things, right? So we're talking about depreciation and amortization, which is, the D and the A in EBITDA. So it's equity before interest, taxes, depreciation, amortization. Depreciation, amortization, we add back because that is based on your balance sheet. That is how you've accumulated your assets, how old they are, and how you're accounting for them. It's non-cash, it's a tax benefit. So because it's non-cash, because it's how you have your own balance sheet, we add those back. We also add back interest, right? Because interest is dependent, again, on your loan structure. If you've got $500,000 in debt on your business and it's a real estate loan over 25 years at 4.25% because you got it a few years ago when life was good, that's one interest rate. Now, if you have the same $500,000 in debt, but it's primarily credit cards, your interest is very different, right? So we add that back because a buyer's most likely going to have their own income statement, their own balance sheet, and their own debt. So if your buyer is a cash buyer, they don't worry about interest because they've already paid that, right? If your buyer writes down all the assets in year one, then their depreciation schedule is going to look a lot different, right? So those things we add back. So we start with net income, add back depreciation, interest, amortization. That gets us to EBITDA. EBITDA is what banks look at most commonly, right? Because it's depreciation, amortization, interest. Those are all legal, they're demonstrable, they're part of the balance sheet. It's the ability of the business to support debt. That's the relationship between those two things. So if a buyer is looking for a loan, then they want to know the EBITDA because their bank wants to know the EBITDA to buy the business. What cash flow is available to support debt? We take it a step further, for small businesses because of that tax mitigation strategy that I talked about, right? So seller's discretionary earnings is the most common Main Street business transaction cash flow term used. There's a lot going on there, I know. It's what cash is available to support debt and the buyer, right? So as you're looking at your business and you're saying, okay, my net income is marginal because I'm trying to reduce my taxes every year, great. That's actually beneficial for a buyer that you have that foresight and that financial awareness, right? And so there has to be some way of showing the legal and demonstrable ways that you're doing that, right? So we add back seller's salary, your actual salary that you've taken out of the business, not distributions, which is after tax, but an expense if you've paid yourself owner's compensation. And this kind of ephemeral term of seller's discretionary earnings. That's really where a good broker comes into play to help walk you through what is discretionary. I think of it as non-operational, right? What is a buyer not necessarily going to need to pay for that you did pay for to have the same business performance? So things like professional development, right, might be considered discretionary. Unless it's required in the industry. Things like a company car, right? If you're expensing a company car and you don't do a lot of travel, but it's nice to have and you have your logo on it, might be discretionary. Family phones, right? Salaries. You might have a friend or a family member who are technically employed by the company and taking a salary, but their responsibilities aren't commensurate with their pay, right? That might be considered discretionary and would be part of a conversation. Again, legal, demonstrable, right? That cash that goes mysteriously missing isn't going to cut it. But if you have something that you can point to and say, yes, this isn't part of operations, but I've worked with my accountant to make sure that, we pass a straight face test with the IRS. I traveled to Florida for a weekend conference every year, and I spend 5 extra days there poking around and talking to industry members, and I expense the whole hotel and trip. Okay, does a buyer need to do that to do the same operations? Maybe, maybe not, right? So that discretionary piece can be broad, and I would work with, again, a good broker, a good accountant to footnote your financials and say, listen, Mr. or Mrs. Buyer, here's what's actually available to you to support debt. Another big one I see is rent, right? If you own the real estate and you own the business, a great way to kind of reduce some taxes is to pay more in rent than is market necessary, right? And have that be a flow through, income to yourself. So playing with rent and understanding, okay, I've overpaid in rent, which has made my operating performance look weaker than it actually is. Let's make an adjustment there. Or Alternatively, and some buyers are growing, more smarter about this, and brokers certainly are, is underpaying rent and saying, oh, look how strong my business is because it doesn't pay rent to this real estate that I own. Well, a buyer's going to notice that, right? And so being aware of, okay, I'm overstating how strong my business is at this point. What is a good market rent rate, and have this show kind of a arm's length transaction where the business has its own value and is paying a reasonable rent to this company. And this is how those two things come together, right? So you go through the process yourself and you say, okay, I want to make my SDE, my seller's discretionary earnings, as strong as possible. I'm going to give myself 2 or 3 years to ramp things up and do those things that I thought I was going to, kept putting off because I'm putting out fires and running around. I'm going to get my point of sale system figured out, and I'm going to put some systems in place and some processes and finally write that SOP that I've been meaning to write. And I'm going to pay myself what I need to be paying. And I'm going to pay more in taxes than I've paid in the past year so that I can show how strong this business actually is. And I'm going to put all this together and show it to a buyer in 3 years. And I'm selling them my approved discretionary my salary, what I've paid myself, my net income, what I've paid taxes on, interest, taxes, depreciation, which I'm adding back because that's mine, and that they don't care about that. They'll do their own calculation. And this is the other side, right? What is the buyer buying? They're buying their own salary needs, right? So if you're a manager and you've got 20 employees and you're paying yourself 10 grand a year, well, guess what, right? Like a buyer is not going to look at that and say, yeah, I'm going to compensate myself $10,000 a year. That works. And I can use the rest of this for debt support. No, right? What's a reasonable salary commensurate with the work that you do that a buyer would expect? So they're going to bring their own expectations of, I'm buying a company of this size with this much in place. I need to pay myself X amount. Otherwise, I just go work for somebody else and pay myself that. So their salary needs in their mind, that's what they're buying, right? Is a job. They're buying a job, and that comes first. And the rest of what they're buying of that SDE that we've calculated, that you've put together, salary needs, and then it's this ability to support debt, right? So you think about how the net income and cash flow supports the balance sheet, right? Okay, we can go out and buy more assets. You don't need to buy assets. Look at the assets that I've created and put in place, and you're buying these assets. Okay, great. Okay, there's equity there. Sure, there's a little bit of there, but it's primarily debt. And the debt is the purchase price. How much debt are they putting on this to support what you're asking for? And how do you make that amount as large as possible to support what you think the value is in your company, right? Those two things have to agree with one another. There's always this DCR, debt coverage ratio, that's thrown in there as well. So if the buyer is using a bank or a lender to buy, everything that is left is usually not available to support debt. The bank doesn't say, okay, there's 150,000 in SDE and you have $50,000 in salary needs based on your personal financial statement, Mr. or Mrs. Buyer. Yeah, let's make the principal and interest payment at least, $100,000 a year. Now, lenders are risk adverse, and so they want a debt coverage ratio, which is essentially saying we'll lend 80% of that, 75% of that. We want a buffer of 20 to 25% in the cash flow, so that if you have to replace that tractor, or you have to replace a piece of equipment, or a key employee leaves and there's a month or two where cash flow isn't what you think, that you don't miss a payment to us, right? So lenders are conservative. If the buyer's coming to the table and needs a note or a loan to make this purchase happen, then they're not going to be able to leverage up that whole thing. They're going to discount it and leverage up 80%, 75%. This is how it plays out, right? So we have the buyer's salary needs, debt coverage ratio, which I just talked about. Everything else can go towards supporting that purchase price. That's where the terms come into play, right? Usually a bank is looking at the life of the assets. So most furniture, fixtures, equipment, tangible assets of a business are 5 to 7 year terms. Interest rates are anywhere from 7.25% to 10-ish% right now. So you can use your SDE and calculate fairly reasonably what kind of debt that can support at this time. Right? You can back into a purchase price as well. You can say, hey, if I want to sell my business in 3 years for this amount or 5 years, what should my SDE be to support that debt? Right? What do I need to show my income is, my ability of the assets to reliably generate cash flow to support the purchase price that I'm looking for, right? And then you have this buffer, right? Okay, well, I want more than that. Right? I think my business is worth more than that. I'm not here to tell you it isn't. But that actual purchase price compared to supportable purchase price, that's going to fall on the buyer, right? It's going to fall to the buyer because essentially what you're asking for is the buyer to go in the hole for a period of time until the business grows to a point that the buyer is able to support that debt. And you have to be pretty convincing to do that. Right? And there are opportunities out there. I'm not saying it doesn't happen. It actually, but it relies, it's a good broker is helpful for it, and a strong narrative to be able to say, we've grown 15% each year in the last 3 years, or we just secured, a long-term relationship with these two, large commercial customers, right? So you can sell that upside, and the right buyer might be willing to pay for that upside. But it's a risk, right? It's a risk to that buyer, and it's a time commitment and a cash commitment on their part to be able to support debt beyond what the business can do now. So you're putting them in a disadvantage. And like I said, you have to be very convincing and be able to tell that narrative very well to get them to understand that value. So we've got what we're selling, right? Predetermined list of assets, tangible and intangible. And that's something that you can be working on now as somebody who's considering selling a business. Are my tangible assets upkept and repairs and maintenance up to date? Or is there a lot of deferred maintenance on these assets that are going to burden, a buyer and put them off? Are my intangible assets transferable? Am I doing the work to have that standard operating procedure in place, to train my management team to oversee things while I step back, to put in place systems of checks and balances, creating, the customer lists and the outreach and the marketing materials, all of those things can be transferred with foresight and work, right? It takes work to do it. So if you have your list of assets, that's a great starting point. Then you need to prove that those assets are generating excess value. That's the idea of goodwill, where you're saying, hey, the tangible and intangible working together can support a larger debt than just selling off these assets. So the process that I've created, this business, tells a better story than just the hard assets. And I can show that, that there's value in the goodwill and the reputation, because look at all this extra cash it produces, right? It's value created by those assets is demonstrable. That's the cash flow portion. It's saying, if all I'm doing is using the assets to replace the assets and I'm break even every single year, then it's an asset sale, right? There's no value being created. There's no excess cash being generated. If there is value, then it's time to raise your prices to recognize that, right? Too often, business owners get in this mentality of, okay, break even's fine for a period of time because I'm not paying taxes and my customers are all happy and I haven't raised my prices in 10 years. Well, it's time, right? If you want to capture that, you need to be able to show it and speak to it and say, people pay me more than just paying for the raw materials or, doing it themselves, because of my expertise, because of my reputation, because of these intangible assets that enhance the tangible assets. And then we get to the targeted buyer, right? Where we say, okay, I've created this, I have this proof of concept. Who is buying it and what are they buying it based on? Right? So that's the distinction. And again, that's something that you can be thinking about now. If you are a general store or a manufacturer of some type, right? And you're saying, hey, the only person who is going to buy this business is either a key employee or somebody who's stepping in and running it 40 hours a week. Well, they only care about the bottom line. So your sales are great and it's fine to focus on sales, but how strong is your business? How much extra cash is it producing? How much can you pay in taxes every year? And how do you maximize that to tell a buyer that story and let them come in and recognize that cash flow from day one? If your targeted buyer is somebody who's just buying your book of business, then they don't really care about your expenses or the strength of your company, to be honest. You don't have to go through the whole SDE thing if your target is like a software acquisition or building a book of business and selling that book, or essentially like a referral agreement of some kind where you're pushing customers to another service provider. That's all about sales, right? So then you're saying, okay, how do I get out there in the next 3 years and drive sales and hammer sales and get new customers and make sure my customers are committed to me and my process, right? Because that's the transferable asset that you're really focused on. So very different approaches to that preparing to sell depending on who you think the buyer is going to be. So let's talk a little bit about what it's worth, right? And again, huge gray area here. And even that analysis of top versus bottom of the cash flow position and the target audience, very distinct values can be taken from that, right? So 3 values that I usually use to kind of talk through with the seller. First would be asset sale. Yep, the coffee machine just broke. You're sick and tired of this. The key employee just quit, and in this job market you have no energy to try to hire somebody new to replace them. All right, what are these assets worth? Do you give yourself 6 months to sell them off piecemeal and kind of get 80 cents on the dollar, or is this a all in, take them to the auction house, get 50 cents on the dollar, give 10% of it to the auctioneer and walk away? That's the floor, right? To just say, okay, you're done with it. That is what it is. Let's sell this stuff off. Is it enough to cover your debt? Hopefully. And we'll move on. Alternatively, I have a ceiling, right? And to me, the ceiling is always, hey, if I have, a small entrepreneur come in to me and say, this is my idea, and I can either buy this business that is being sold by such and such, buyer or seller on Main Street, or I can hang my own shingle and run the business for a few years and try to put the seller out of business. What is that ceiling value? The buyer's alternative is always to do it themselves, right? And if they're looking at it and they're saying, well, this seller is asking an astronomical fee that isn't supported by cash flow, and for half of what they're asking for, I can cover 3 years of operations and rent and all the inventory and equipment I need. Guess what? I'm going to roll the dice on myself and, leverage less and have less debt and be less committed and do it the way I want to do it, right? So that's the ceiling that I use for a seller to consider is if they're asking too much, they're going to create competition, right? By driving a buyer to just do it themselves, right? And actually diminish the value of their own company in the long term. And then we have the sweet spot in the middle, right? Which is market value. What is market value? Market value is essentially a buyer and a seller agreeing on a price. So if the buyer looks at it and says, that's a reasonable price and it's better than I could do trying to do it myself, and I have these intangible assets that I can readily tap into, great. If a seller's looking at it and saying, hey, there is value created by my intangibles, and I'm going to put that out in the market and find a buyer, and you haggle a little bit and negotiate, and there's a handshake agreement, that's the market price, right? That's how it's determined. And I know, brokers have different calculations, and there's discounted cash flows, and there's, market models, and there's income-based approaches and everything else. But essentially, the starting point is always going to be, will a buyer be convinced by a seller that the value is there, right? And where is that middle ground for the two of them to meet? If that value is greater than the asset value, that's goodwill, right? So there's a lot of confusion around what goodwill actually is and what it means, but essentially it's market price less asset price. So if there's intangible value, or if there's purchase price value assigned to intangibles, that is goodwill. Goodwill isn't created until the transaction's completed, right? And the hope is that it will be. So if selling, to an owner operator, like we've talked about, the business has to be able to buy itself. That's this concept here, right? The historic SDE has to support the purchase price or be close. Otherwise, the owner operator will fail. They will sink under the debt created by the business. What about multiples, right? A lot of people love using multiples. It's very easy, it's quick, it's comprehensive. So people say, I can understand that. 2 times SDE. Great, that's a good starting point. 60% of the top line of my annual sales. Even better, I don't have to worry about the SDE calculation, right? Again, the type of multiple to use is really determined by the buyer, right? So if your business is break even for 4 years and you're selling to a key employee because at 60% of your top line, which is $1 million, that key employee is going to look at this and say, great, I'm going to take out a loan for $1 million and I have no cash to pay it back. So it doesn't work, right? It's dead out of the gate. And that poor employee isn't going to last very long, right? So you can only use a bottom line multiple if you're considering the family member, the key employee, and owner operator. A top line multiple is only really used when it's that book of business, when that buyer is saying, I don't care about your expenses. I care about your customers, how many customers you have, what their average sale price is or purchase price is, how long they've been, loyal customers of yours, and how easy it is to integrate them into my workload. Again, it's a starting point, right? So usually you use some kind of weighted average of the last couple of years to get to that number, because if you do $150,000 in 1 year of SDE and $100,000 in another year of SDE and $220,000 in the 3rd year of SDE, that's great. It's strong. You're producing cash. But are you using just a 3-year average? Are you using the most recent year first? So right off the bat, there's a discussion with the seller of, or with the buyer of, what numbers are you using, and does it make sense, and is there reasonable weight given to them, right? I've seen a buyer and a seller in the last couple of years agree that we're going to throw out 2020 and 2021 and use 2022, 2019, and 2018 because the business had recovered to pre-COVID levels, and those 2 years of COVID were really kind of one-offs, right? And the hope is that there's a better narrative to say of, okay, those 3 years tell the story of where this business is going. And that's the communication with the buyer, is the way I've weighted this, the way I've looked at it is a continuation of the narrative, right? If you're asking for more than what is supportable, but you've increased sales and SDE by 10 or 15% each of the last 3 years, that's an easier story to tell. Look at this trajectory. Look at how well my advertising and marketing is coming into play. I've done this, this, and this with my standard operating procedures and really just enhanced this business. And here's where I see it going, right? Yeah, a buyer can get on board with that and understand. So tell that story. Use the historic weighting and the performance to say where the business is going. Year-to-date financials are a great way with that too. Yeah, we've shown growth, but also, look at this year compared to last year. I'm already, $100,000 stronger than I was at this time last year. Great, good story, right? What's a discretionary one-time add back? That can be negotiated and disagreed upon. So the more you're adding back to support that SDE, the more opportunity there is for a buyer to step in and say, travel's not really SDE. You're a service-based business that does work at people's homes. You've got to get there to do it, right? If you're a plumber or an electrician, you can't just write off travel as a discretionary expense. That's operational, right? So again, understanding what's provable, what's reasonable, what's easily explained to that buyer so that they say, well, okay, that makes sense. Quality and age of tangible assets, a huge one, right? A multiple of cash flow has no relation to the assets themselves. If you think about it, it's all intangible assets, how well those assets are being used. If you're doing great over the last couple of years, and all of your equipment's held together by duct tape and clothes hangers, well, a buyer is going to look at that very differently than a business that's been doing great and has brand new equipment sitting there, right? Because they're looking at that, and at the first example, they're saying, yeah, it's worth $1 million, but I'm going to have to put 200,000 into the equipment in the first year. So I can only afford to pay you 800,000, right? So one of the things we'll talk about in preparing to sell is deferred maintenance, right? There's that instinct as you think ahead and you say, okay, I'm bringing this to market and I have, inquiries. Do I have to stock the shelves? Do I have to keep my inventory where it was? That tractor is kind of on the fritz. Should I just, give it a good thud and hope I get another month out of it? Yes and no, right? It's hard to reinvest in a business when you're thinking, geez, I'm going to be out of here in a couple months if everything goes according to plan. But at the same time, are you giving the buyer some hesitancy, some pause, a reason to think twice, right? Time kills all deals. And the more a buyer says, well, I checked under the hood and that vehicle is not great. And you said there's $700,000 in inventory, but it looks like 300,000 of it's just been collecting dust on the back shelves. Where do I need to start this negotiation process? It drags on, right? So multiples are great. It's a starting point, and understand which multiple you're using to start that conversation. So you've got a price, right? We've gone through all this. You're like, yeah, I've got my assets. I've identified them. I've listed them. I've put together the standard operating procedures. I took a month off and came back and everything was great. This is good. I found a buyer. I went out in the market. I used a broker. I didn't use a broker. I just talked to a key employee and they said they were interested. We have a deal in place. They put together a purchase and sale agreement and I love it. But wait, what's this, right? There's a financing contingency in the purchase and sale. Yes, right. So any deal, typically any asset purchase, just like buying a house, if you've done that recently, last 10 years, 20 years, the purchase and sale agreement has two contingencies that you have to get through. One is an inspection contingency, right? That's fairly easy, straightforward. Come look at the equipment. Yes, I replaced that tractor. Yes, I cleaned out my inventory and wrote off old inventory. Everything's looking good. The second piece is a financing contingency. The buyer usually, unless they're a cash buyer, which is rare, has to be able to finance the deal, right? So how do you structure a deal and how do you anticipate structuring a deal and understand the buyer going through that process? So the easiest way to do it is to have physical assets associated with it, right? So if you have real estate, furniture, fixtures, equipment, inventory, the lender, any bank will look at that first and foremost and say, okay, I will lend a loan to value ratio against that, right? And the loan to value ratio is essentially them saying, if I have to take that back from you and sell it, then I'm going to have to pay a real estate broker. I'm going to have to pay an auctioneer. I'm going to have to pay an attorney to seize it and change the deed over. So I'm not going to lend the buyer 100% of the value. I'm going to lend them a ratio, 70, 80, 50% of it. Inventory is the hardest hit there, right? Because the bank's looking at that and essentially saying, well, geez, if the buyer can't sell this inventory and turn it into cash, what am I going to do with $200,000 worth of popsicles, right? I'm a bank. I'm not a popsicle salesman. That's I might get 50 cents on the dollar by throwing a sign up, right? And hoping for the best. So I'm not going to lend to you, the buyer, 100% of the value of the inventory. Because in essence, if I have to take that back from the buyer to sell, it's already proved to be worthless. The buyer wasn't able to find buyers or customers to support it. So what chance do I have as a bank who has no experience in this industry? So that's the baseline, right? Standard commercial debt just based on the assets, tangible assets of the business. Well, what if we're in this situation where we're looking at it and we're saying, hey, we've got, a market price, we're a buyer and a seller. We've already agreed that this is worth $1 million. And now the buyer's finding out that they can only borrow 600,000. Where's the other 400,000 supposed to come from? So buyers can offer a personal guarantee, and they often will, right? A lot of lenders would require that. So if the buyer has other assets that they're willing to pledge, equity in a home, 401ks, whatever it is, cash in a bank account that they just don't want to spend. And the bank might be willing to lend more than just against the tangible assets of the business. A seller note, like I mentioned, about 75-ish% of the deals that I've worked in this market, Main Street businesses, the seller is involved. Typically, hopefully, just as a debtor, right? Just principal and interest payments, they get a lump sum of 600,000 on the day of close and a secondary note behind the bank for, 400,000 to be paid over X number of years. And the cash flow's there, right? So the SD can support that, and you're looking at that. Another alternative would be some kind of consulting agreement. Right? I had a florist a couple years ago that got paid an additional $5,000 for a phone call 7 times a year for the first 2 years, right? And it was like Mother's Day, Valentine's Day, all the big florist holidays. And so the buyer said, we've agreed upon this price. I can only borrow this much to pay you, but I'll pay you, for a phone call 2 weeks before these major holidays. And the seller said, you know what? Yeah, for 70 grand of the purchase price that we've agreed upon, I'll take 5 grand at a time for an hour-long phone call. That works for me. And they, the cash flow worked. It worked out of the business, and there was some value there. So that, that's an extreme example where it was 7 hours a year, or you could have a consulting agreement where you say, hey, I'm selling you this. There's a lot of intangible value here. I understand that I'm still valuable, and some of the stuff I simply can't transfer in writing. Hire me for 3 months, and I'll come in 20 hours a week and check in and talk you through this, and I'll introduce you to customers, and you'll pay me a portion of this purchase price that we've agreed upon through the cash flow of the business for that. Right. And the last bullet point I just threw out there, if you agreed upon a purchase price and you think the business is worth it, but it's not supportable and the buyer's not there and it's a key employee or a family member, work toward it. You can have that conversation and say, I will give this business to you for $1 million. And I'm going to transfer some management and some ownership to you in a tiered structure. And I'm going to retain ownership of it for 4 years. And I'm going to reduce my input to about 50% and still take 100% of the salary. And I'm going to recognize some value over those 4 years. And at the end of 4 years, you're going to pay me 600,000. And if you miss these benchmarks or don't do this, then I get the company back. Right. So you can put that in place and say, listen, I think it's worth $1 million. You think it's worth $1 million. A bank's never going to lend $1 million. You have a credit score of 440 and, you rent a home and don't have any equity, but the business can pay for itself. And we're going to put in a structure where I step back and you step in. And for a period of time, I keep ownership. I keep the reins and let you drive. And once we have proof of concept and proof that you can do it, then you can go out and get a smaller loan and buy me out. And we'll transfer equity as we go. To me, that's the most fun, right? Is that point where you say, okay, I've got this buyer, now let's figure out how it works. Let's make sure the cash flow works for both parties. I don't want to see my little baby, fail. I don't want to see everything that I've invested my heart and soul into um, show up in the news in a couple of years as going out of business. So I'm not interested in overburdening whatever buyer steps into this. But at the same time, I want value out of it that I've created. So what am I doing? How am I telling the story and helping the buyer, work together to make sure that this business stays in business, that the customers continue to be satisfied, that the employees continue to be paid a reasonable, rate for their work, and there's good jobs being created. That's fun for me, like as an advisor, to walk through that creative solution of how do we get this to work. So let's step back for a minute. If you're a few years out and you're saying this all sounds well and good, but I'm 3 years away, 5 years away, 10 years away. So I don't know what it's going to be worth. I don't know who my buyer is. I'm just curious about, when, if. Let's talk about that, right? So how do we set the table? Like I've mentioned, right? The easiest way to do it is make yourself replaceable. I do apologize. I know we're coming up on time. Like I said at the beginning, I've got about 10 minutes left to go through. If you want to stick around, that's wonderful. Love having you. If not, feel free to hop off. This slideshow and presentation will be emailed to you, and you can watch the rest of it later. But I'd hate to interrupt your lunch if you're about to step out and go have lunch. So setting the table, right? Prepare yourself to make yourself replaceable. I think that's the hardest part, right? You are the business. You've been the business. You thrive when the business is doing well, right? It's that enjoyment of being the owner. Why would you make yourself forgettable and replaceable, right? It's because you want it transferable. You want to be able to say, well, listen, buyer, anybody can do this. This is easy to step in and run this company. I've set it up. It runs itself. I check in, I talk to my key employees, I make sure that they're satisfied. I grab that customer that I know has been coming in for 20 years and have a joke with them. I call a vendor, replace some inventory. But you just follow this and it does itself and everything's going well, right? That's the dream, is to be able to just enjoy being a business owner. So you can do that now, right? You can lay that foundation now and put those guardrails in place to make it easy to say, I can step away and come back. I can step away, I can come back. I can step away and a buyer can come back, and it'll do it, right? Make your financials understandable. One thing I'd say you could do today, right, would be to go to your QuickBooks and run an income statement and look at your chart of accounts. If your chart of accounts goes for 10 or 15 pages, that's not great. If you have other miscellaneous other office supplies, other office miscellaneous, right? You lose sight of the forest through the trees, right? So clean it up. Say, okay, you know what? I've got 15 miscellaneous accounts. I'm going to crash them together, and it is what it is, right? If it's less than 0.5% of revenue, does it really matter, right? Oh, we switched from K cups to Nespresso last year, so I have a separate line item for that. It's coffee, and it's not even coffee, really, right? It's office supplies, so put it in office supplies. So the clearer that is, the easier it is to read the story that you're trying to tell the buyer, right? So use that chart of accounts sparingly, reduce accounts where you can, and be able to explain those year-to-year discrepancies. Obviously, COVID was a huge one in 2020 and 2021. But 2022, 2023, most companies either pivoted or recovered. So being able to tell, okay, what are the major changes between those 2 years? What are the major changes between those 2 years and where you think you're going in 2024? Can you have that conversation quickly and point to that? And when, a buyer says, well, gee, this line item changed dramatically. Why is that? Well, I shopped my insurance company. I didn't reduce, my insurance coverage or anything. I just noticed that it was going up. I controlled that and brought the price back down. Or, yeah, repairs and maintenance jumped that year because we got caught up on a lot of stuff. We had a stronger than average year, and we wanted to reduce our taxes in November, December. So we had, replaced the roof and replaced that major piece of equipment and just wrote off the whole thing as repairs and maintenance. Are you going to need to do that as a buyer? No, not for another 15 years. It's a good roof. We just put it on. Pay your taxes, right? That's the other piece, the legal demonstrable. If you're thinking 3 years out, 2 years out, the more you pay in taxes, the easier it is to have that discussion with the buyer. It's unfortunate. I hate the actuality of it. But if you can say, geez, yeah, we got nailed on taxes the last 2 years because look at how strong and profitable we were. That's a good problem. Right? It's not the worst thing in the world. So keep up capital. We've talked about this. Start identifying buyers because that'll really dictate the story that you tell, right? If you're all about that top line, like I said, go drive customers, invest in advertising and marketing, bring in new customers, get those reviews out the door, get people to leave comments on Facebook and Google or wherever your other customers are, because you want to be able to tell a buyer, this is the story. Look at how many customers we have. Look at how positive these reviews are. Look how strong this asset is that I'm selling you. It's the bottom line, then that's a whole different investment. You're saying, okay, where can I control my costs? Where can I maximize my efficiency and my performance? Where can I drive my operations, make my team better than they've been, right? To make this as strong as possible and phase out your role. In the last year, if you're 12, 18 months out, that's the time to start finding a broker, an accountant, an attorney, right? All three of those will be incredibly helpful to you as you go through this process. The cleaning up the financials, the navigating the purchase and sale agreement and contingencies, and and bringing it to market, right? A broker is one of those things that, especially if you don't know who the buyer is, you're thinking, I've got this one key employee, but they really aren't interested, and I don't have, my son or daughter has no interest in doing this because they see how hard I work. Then you need to take that to a business broker. I would not even say a commercial real estate broker, but a true business broker is somebody who understands sellers' discretionary earnings, who understands industry buyers, who understands goodwill values and confidentiality, right? Like I led with, this is confidential. This is a sensitive topic for a business owner. So you don't want to hop on Biz by Sell and see the name of your restaurant, at the top of that. Your customers are going to be asking questions. Your vendors are asking questions. All your employees are like, what's happening, right? So make sure if you go the broker route, if you go the mass marketing route and outreach, that you're using some kind of confidential flyer or teaser that solicits a confidentiality agreement being signed and then moving forward. Or not, right? If you're like, hey, my most likely buyer is going to be a customer or an employee, I'm not worried about that at all. Great, up to you, right? But to me, think about that before you engage with a broker, because a business broker is very different than just Aunt Lori, who's sold 2 homes as a residential real estate agent. No offense, any Aunt Lori's out there. Clean up your balance sheet. That's a big one, right? That idea of, okay, what inventory is being included? If you have hundreds of thousands of dollars in inventory that's been sitting on the shelves, time to sell that off, clean it up, right? Replace the assets that need to be replaced, maintain what needs to be maintained, pay off that old debt that needs to be paid off. It's sensitive when you start talking through that with the buyer, right? And so the easier it is for you to say, here's my balance sheet, it's clean, all the assets are up to date. I've got 2 business loans that I'm up to date on and nothing else. Great, no questions, right? That's the goal, is to make that time period between getting the buyer and them buying the business as short as possible. And so if you have those questions answered and you've done that due diligence and you have, your financials footnoted with explanations about every, variance that has occurred and tells that story, it takes a lot of the guesswork out and uncertainty for the buyer. And that is helpful. And then take time off, right? That's a big one. That's that idea of, okay, I've put this operating procedure into place. Can I step away? How well does this work? If I leave and come back, do I then find things that I should have said or should have done or should have put in place that I can then do so? Or alternatively, right? You leave for a month and come back and everything's copacetic and you're like, hey, you know what? I don't really feel like selling anymore. This is going great. I'm actually enjoying this for the first time in 10 years. That's I've had sellers do that as well. And then reflect, right? So plan for that week after, that month after. I always like the second bullet point here. How do you handle somebody dyeing your baby's hair, right? Because that's what it's going to be. You actually walk out of that closing room, and you feel this huge sigh of relief, and maybe you go have a nice, glass of whiskey that you've been saving for that day, and the next day you drive by and the sign has changed, or you drive by and they've painted the outside, or you go in and you talk to the seller for a while and you realize that they switched from Coke products to Pepsi products, whatever it is. How are you going to react when that happens? Do you feel a personal affront that they have taken it upon themselves to change everything that you did so perfectly? Or are you okay with that, right? And so give yourself time before that sale to consider those things and put yourself in that situation and say, okay, how does that feel to me? And am I okay with that? Or do I want to write in the purchase and sale agreement, the buyer agrees to only use Pepsi products for the next 10 years, right? You can. That's the fun of having a good attorney, is whatever you think of, you can put in there. And if it's important to you, it's better to know that now than the day after. And then this is just very common in boredom more so. So having that compensation agreement where you stay involved for a period of time is great for having that next step. I had a seller who sold and flew to Georgia the day after close and hiked the AT. And that was, their lifelong dream. And they just said, you know what? They bought their ticket like 6 months before, and a couple of contingencies came up, and I was like, man, you're gonna cut it close. But everything came together and they did it. And for them, it was just a chance to unplug and refocus. And by the time they got back to Maine, at the end of the AT, they'd moved on, right? And it was easy for them to kind of step away and have that separation. So don't be sitting around twiddling your thumbs the day after. There's plenty of anxiety out without adding to it. So, like I said, went a little bit over. I apologize for that. I appreciate those who stuck around. But here's our contact information. We are here for you. We love talking about this stuff and talking through it and helping you through this process. Everything that we do one-on-one is confidential. It is free. I forget if I mentioned that. Or sorry, no cost is the term we use, because we do ask that you fill out surveys and everything. But we're here for you, and this is one of many things that we like to talk about and support entrepreneurs with. So please reach out if you don't have a business advisor. We're always happy to help. Thanks for joining us today, and enjoy this wonderful weather.